All right, so I want to start with something that folks might not know about you and Column at all, and I was surprised to learn. You guys are based out of Presidio in San Francisco, and you have well, I should say start with, for those who don't know Column, although I'm sure you haven't seen them all over Money 2020, these guys were founded and started onboarding their clients back in 2022, and they now have clients including Brex, Ramp, Built, Mercury, and Wise. They help provide banking services to a bunch of unicorns in the fintech space. But so let me now go back into where you guys are now. So my understanding is that you guys have you're based at Presidio, and you offer a really fascinating stipend for folks to be basically within a 2-mile radius of Presidio, $2,000 a month, right? Can you tell me what led you to make that decision, why you are doing that?
So I think there's a pretty consistent trend you're seeing with a lot of the top companies of actually moving people back into the office. We all did this, remote thing during COVID, worked really well. We realized that actually in person is pretty good. And there's two types of companies. There's JP Morgan, who can spend billions of dollars on our new headquarters and convince everybody to go there. But for the rest of us plebes, we have to figure out a way to get everybody else back in the office. And I think, we have the luxury of being able to provide nice food, nice offices, but we also looked at it and we're like, hey, if we're going to make people make the sacrifice of moving close to the office, we should help them do that. And so one of the things we did is we were actually giving people a $2,000 a month rental stipend if they're living 2 miles to the office. Turns out it works really well. We had a bunch of people relocate, and it also kind of helps people in San Francisco justify the move. Because what I have to do is I have to say, okay, you're going to be from Chicago, you're going to be from Austin. You guys can get an amazing 2-3 bedroom apartment for X dollars. If you move to San Francisco, you're going to move into a 1-bedroom. It's going to kind of suck. It's like, what is that price differential between those markets to actually make your standard of living comparable to the Chicago, the Austin, the Denvers, et cetera? And so we found that it's been super effective, and now people are back in the office 4 to 5 days a week, and it's been a huge hit.
Yeah, how many people is that out of your total headcount?
I think we have like 80+% of the people come to the office 4 to 5 days a week.
Oh wow.
Yeah.
Oh wow.
We're also a smaller company. We're only about 120 people, right. So it's a lot easier to do than if you're a massive company.
Right. I mean, so you're famously bootstrapped, right? Like you came and applied, you made your money, you then used that to buy the bank.
Yeah.
Do you think you would have been able to do this, to offer this stipend, had you had venture backing and had pressures to speak to venture investors?
Yeah, I don't tend to like the word bootstrap. I don't know what you mean there, right? Sometimes people think bootstrap, they think there's like a lack of ambition. It's like a small business, you're trying to do it yourself. I think we have even larger ambition than every other venture-backed company. We just think there are different funding models today than there were before. I think given AI, given the way software is being built today, you can be a much leaner company than you could before. At Plaid, amazing company, I had to hire 1,000 people to do something. I don't have to do that anymore. And so I don't have the same cost structure. And so I can actually build a company that is profitable from pretty close to day zero, use those earnings to invest back in R&D, invest back in software, and build a venture scale business, something, I think we're probably one of the faster growing software companies out there without actually having to raise a lot of venture capital. And that is great because now I can say we're 100% employee owned and founder owned here. And that just changes the dynamics. I don't have a 10-year sales cycle. I don't have to think about liquidity the same way that venture-backed companies do, but also I can go to my partners and they can feel that we are in it from a longer-term horizon.
Right. Well, so I think there's also, you guys have a really interesting, the employee-owned side, right? Because equity is a really important part of the founder journey, the startup journey as well, and for employee retention. You guys do have a really interesting equity structure.
Yeah.
In terms of you basically, right, in a typical equity structure, the investor takes their principal back, and then whatever is left over is left for the employees. Yeah. And that's not always completely 100% aligned with the exact percentage amount that the employee has in the company, and therefore they might get a lower amount.
Yeah.
Very complicated way of saying, do you think that model is going to get more widespread, or do you think it's only possible within companies like yours?
For the finance nerds out there, we wrote a blog post on this called Unlocking Equity, and what we talk about is how the kind of traditional startup equity model we think is broken. And I think you start to see this. If you look at OpenAI's profit sharing units, and there's a bunch of different companies on the bleeding edge, including ourselves, of how do we allow employees to get the upside of the company, but also have some liquidity while not also always prioritizing other investors. I think very strongly it's employees who build companies. It's not the VC who happened to write a $5 million check like 7 years ago. They're valuable, they're needed, they're amazing, but I think the employee should have a bigger incentive than everybody else. And so we've structured our company in a way that we think preserves optionality for people, but also provides liquidity and puts them first in line versus somebody else.
Well, do you think that there's a possibility that this becomes more widespread, or do you think it is, right, something that only companies like yours would be able to achieve, right, that you don't have this VC backing?
You know, a hot take here. I think Silicon Valley pretends to be contrarian, but I don't think we are. I think most of Silicon Valley is like building startup by picture or something like that. Everybody reads the same like YC blog posts and like, this is what I have to do. I build my company. I have to do this safe. I have to like raise a Series A, Series B, Series C, etc. And so I don't think so. I think there are founders that have done this before, look at what's broken, and think about this from first principles. And if they're willing to invest the time and money to do something different, there is a better structure out there. I don't think it's going to be super widespread. There's probably too much of an industrial complex around this for it to be widespread, but I do think it's better.
You do think it's better? Yeah, it is. I think it's like the VC model. I feel like it rarely changes. Their stock value change, but if you're talking about the fundamentals, it rarely changes.
Yeah, here like Silicon Valley is a great business model, but it's built on some primitives that it's hard to challenge, right? And I do think we are challenging those to an extent, but I don't think it's going to be like super widespread. I think the large, you see this in Anthropic, you see this in OpenAI, you see it in some of these companies that are extremely fast growing and have like a differentiated ability to do this. Like a lot of them are not using the standard equity model. So I do think the kind of like top companies are going to switch over to this model. Stripe's always been like relatively forward thinking how they think about equity. And so they start to do the different things as well about 3 years ago. Yeah. So I do think the top companies will do different stuff. Okay.
So you've alluded to the fact that you guys have grown quite quickly, started onboarding customers in 2022. Tell me, right, like where is your financially, give me an update. Where are you guys at the moment?
Yeah, I think we've been really lucky. We've gotten to grow really quickly with our customers. We are quite profitable. I think one of the things that we thought early on is we want to make sure that we control our future, and you cannot control your future unless you generate a lot of cash flow.
Yep.
So
you're a bank, so that's something that
Yeah. Being a financial institution, it's important to be building capital all the time. Fortress balance sheet, it's a thing. So I think we've been lucky enough to grow super quickly. So, we've been in the 9 digits of revenue and 9 digits of profits for a little bit.
Okay, and tell me a bit more.
Yeah, no, I think everybody else can look at our call report and figure it out from there. So
Okay, I guess I'll like send out a note afterward.
Okay, yeah, you can send it to our FDIC page and they can read it.
Okay, well, like how much have you guys grown then in that case, right, from last year to this year?
Yeah, like our profits probably grown about 250%. Our revenue has grown a little over 200%.
Okay, so this is interesting, right? Because my question then is, what's been driving the growth?
So I think if you're looking at our business, we probably look a little bit more like a narrow bank. So majority of our revenue is driven by software. And I think we have done a good job on picking the right players in the right space and growing with them and being able to build the right technology and grow out there. At my last company, I did a little bit more of a PLG motion. We had thousands of customers. That's not the case anymore. We have 45 customers. We grow with them. We invest in them. And every time they launch a new product, we want to be first in line, and we are super collaborative there. And so a lot of our growth is due to our customers are doing really well, and they're building in good spaces, and we're able to support them.
Okay. Well, so give me some of the macros, right? Because some things have changed dramatically in the last year or so. Crypto is now okay again. You have a bunch of banks that are jumping in, right? Have there been macro trends that have been driving this?
So I think broadly from like a fintech and financial services perspective, we're still in a bit of a winter. But I think what's happened is like power is accumulating to the incumbents. And so if you look at the Ramps, the Brexes, the Mercuries, the Plaids, like the large companies, they are getting more scale, they are getting more revenue, and they're growing bigger. I think it's a hard place to be from a fintech sector, somebody still in the seed and Series A side. AI has just completely taken over everything. And so from a funding mechanism, it's quite hard there. But there's still a lot of growth capital for good companies. And I think we have historically focused on larger companies. And so that's been quite helpful. There's obviously a lot of movement in the stablecoin space. I think that will still play out. I think we're still in the early days. There's obviously a lot of money to be made, but there's a lot of companies.
Yeah.
Most of them aren't going to survive. Most of them have bad business models. But there are some really good players in there. We're happy to support them. We like that sector. But it's still pretty crowded.
Right. So I have to ask you because now everything, whenever someone brings up payments, it's like stablecoin comes up next. Are you guys doing anything in stablecoins?
Yeah, I think we like the digital asset space. I think we like stable coins, we like crypto. I think we haven't kind of announced publicly what we're doing there, but we are helping some of our companies in this space. I think stablecoin is going to be an addition to it's not going to be a standalone product.
Okay, like you guys are not going to be a stablecoin. Like not everything is going to be stablecoin.
Yeah, like 100% of business is not going to go to stablecoin. I think, you know, I'm sure probably people in the room agree. I think stablecoins in the U.S. domestic payments are kind of a nothing burger. They're not really going to be effective. They're mostly right now in the cross-border international space, which we're quite strong at. So I think we will continue to see a lot of innovation there.
Yeah, and I guess do you think that that's going to be where you guys go more international at some point?
You know, we are going to go where our customers go. I think a lot of them are pushing abroad, and we have already followed them there, and so that's where we're going to see it.
Okay, fair enough. So I also want to talk very briefly. I know we're running out of time, but BaaS has changed so dramatically in the last year. We've had a couple of different events that have been happening, right? We've had Synapse collapse. Evolve has been not so secretly having issues with their CEO currently. And we're also seeing like the Skinny Master account come out, talks about the Skinny Master account. And all of this is going to change the competitiveness of the existing BaaS players. And you guys do play in that space. And my question is really like, where does Column sit in all of this, right, in this post environment?
Financial services has always been completely filled with grifters and charlatans. It's always been that case. Like a majority of people in financial services are like honestly somewhere between like a charlatan and a crook. I think BaaS is no different. I think a majority of the players who played in the space historically had no business doing there, and they went out of business as they should. I think the players that they stand right now, I think there are some legitimate players out there. I don't really like the term BaaS. We like to say infrastructure platform bank, but that's just my personal preference.
Wait, why don't you like BaaS?
You know, because we're not renting out the bank, right? Like we are providing software on top of our bank for people to use. Historically, people called that correspondent banking or wholesale banking. And I think what some banks that you mentioned did, what they did is they essentially just rented out their charter and let people go to town. That's not what we do. That's not what the legitimate players in the place do. JP Morgan's doing like a version of this called wholesale payments for a long time. They're great at it. We are just kind of taking that to the next level. Better software, better APIs, better payments. So I think it is a continuation of a theme that's been in this space for a long period of time. We're just doing it, different model, better technology.
Okay, basically, fundamentally, you don't like. There are BaaS players out there, but you're not. What you guys are not doing is not.
I kind of think we're in a league of our own, but I'm allowed to say that. So.
Okay, awesome. Will has got to run to a flight apparently right after this. So thank you so much for joining us and
thank you.
slotting us in.